Every great city has a great university. UNC Charlotte is Charlotte's great university. With nationally ranked academics, game-changing research, and trailblazing students with the grit to change the world. We are Charlotte's great university. Come see what's great only at Charlotte.
Good afternoon, Forecast fans. I'm Artie Zalanti, Senior Associate Dean of the Belk College of Business at UNC Charlotte. I'm pleased to welcome you to the North Carolina Economic Forecast this quarter. It's wonderful to connect with the business community, our alumni and students, both in person as well as online. A special welcome to the Interim Dean of the Belk College of Business, Dr. Dolly King. Thank you for joining us today, Dolly. And thanks to our sponsors, LPL Financial, the DuBois Center, and the School of Professional Studies. The DuBois Center at UNC Charlotte, Center City, brings the university's intellectual resources to the heart of the Charlotte community. It's a place where you can work on your MBA, your professional continuing education requirements, or your uptown network. It's the perfect venue for meetings, conferences, staff training, receptions, seminars, and more. The UNC Charlotte School of Professional Studies, housed here in the DuBois Center, offers more than 200 programs geared toward working adults, including professional credit programs, degree programs, graduate certificates, and online programs. And I will put a plug in. We just had approval for an online undergraduate degree completion program in the College of Business. Right, and we're working with the School of Professional Studies on that. The intended target is individuals who have stopped out. So if you know people, we'll start in spring of 25. Right. So thank you to both the DuBois Center and the School of Professional Studies for your support. We're also thankful to our friends in the business community, like LPL Financial, for providing essential funding for this event and the research that underlies the presentation. So at this point, I'd like to welcome Scott Liberman, Associate Vice President, Strategic Partners for LPL Financial, for a special word as our sponsor.
Good afternoon, everybody. Super excited to be here. This is always the best event. Love it every quarter. I'm Scott Liberman, a proud alumni, and I work at LPL Financial. If you're not familiar with us, we have over 22,000 advisors. We have a huge campus in Fort Mill, South Carolina. And if you're interested in any of our research material or joining LPL or anything like that, lpl.com, check it out. Reach out to me, Scott Liberman. Happy to get alumni involved with our company. Again, we're really excited about the partnership here at UNC Charlotte for the Belk College of Business. And I don't want to take any more time away from Dr. Connaughton and this amazing forum. Hopefully, North Carolina is doing good economically. Fingers crossed.
Thank you, Scott. LPL Financial's generous support is a great example of how Charlotte business community helps us fulfill our mission to serve the community as North Carolina's urban research institution and business school. Any first-time attendees? Anyone who's been here since the 1980s? I see some hands, so whether it's your first time, your 49th time, you've been coming for 40 years, or anywhere in between, we'd like to welcome and thank you for the support you've provided. If you haven't visited us here before, the DuBois Center at UNC Charlotte Center City is the home base for our graduate programs. We offer a variety of part-time programs for working professionals and executives, including our nationally ranked Charlotte MBA program, featuring both in-person and online options. To our presentation, we'll have a question and answer period with our hybrid audience following today's presentation. If you're joining us virtually, please submit your questions via the Zoom chat at any time. So it's my pleasure to introduce my colleague, Dr. John Connaughton, Professor of Economics in the Belk College. For over 40 years, John has been analyzing the data and sharing his expertise on where North Carolina's economy has been and where it's going. And so please join me in welcoming my fellow 49er with the forecast, Dr. John Connaughton.
Thanks, Artie. Appreciate it. Good afternoon, everyone, and thanks for coming. And for all those that are online watching us on Zoom, hello. All right, so we're going to do this hybrid, and we'll see how it goes. This is our fourth quarter 2023 economic outlook, and today we're going to talk about the 23 GDP and the employment outlook. Most of the numbers are in, but not all of them, so it's still an outlook, not finalized yet. We're going to talk about what happened to the recession. Did anybody see it last year? I missed it, okay. The big question, and of course we had a big conference yesterday after the FOMC meeting with Jerome Powell, asking the question of Will inflation return? And we'll talk a lot about that because that's something that's very, very much concerning, I think, everyone. We'll talk about the economic headwinds we're looking at in 2024, and then finally we'll provide the 2024 GDP and employment forecasts. So, what took place or what's taking place in North Carolina in 2023? It has been a roller coaster year. So we started the year with 3.4% real GDP growth in the first quarter. It dropped down to just 1.1% in the second quarter. And then in the third quarter, just like the US, it picked up tremendously back up to 3.4%. So far, we're looking at, I think, about 1.8% in the quarter that we're in right now for GDP growth, which is probably a little bit better than what the US is going to do. Because I looked at the Atlanta Fed tracker, GDP Now tracker, and as of Monday, it was looking at about 1%, 1.1%. So we'll probably do a little bit better than that. But you know, you put these two bookends here, and you wind up overall at 2.5% growth for the year, which is a little bit better than what we really expect long term, which is closer to 2%. So 2023 is actually going to turn out to be a pretty good year. On a sector-by-sector basis, and for those of you that are new, I'm going to take a second to explain this chart. This kind of combines growth rates over here of the individual sectors of the economy with pie chart information here. So if you add this up, it comes to 100%. So this is like a pie chart. So the horizontal axis is scaled for growth. The vertical axis is scaled for the percent of total GDP that the sector makes up. If you look at the size of the rectangle, you get a sense as to how important that individual sector was to the overall growth in the state. Bigger area rectangles were more important to the overall growth. Smaller ones, not so much. So what you've got is finance, insurance, and real estate, which is almost 20% of the economy, but only grew by 0.2%. So even though it's pretty big here, not so much there. It's a small rectangle. And you look at the ones that are pretty big, business and professional services, information, these are the ones that contributed mostly to the overall growth level. On a job side of things, it was a really good job year. I mean, we all know what happened in 2020. 21 and 22 were big job growth years as we were recovering from the COVID shutdown. So to have in the third year, almost 100,000 net new jobs created from December to December is a pretty solid year. And you can see where most of them are. They're all down here in the services sector. This is business and professional, education and health, hospitality and leisure, and other services. This is where all the growth. What's kind of interesting, real quick, finance, insurance, and real estate make up 20% of the state's GDP, but only 6% of jobs. So it's a very high productivity sector. And but not a big job creator. Okay, so there's where the jobs are, all down here. These are all the jobs here. A few jobs in retail and wholesale trade, but other than that, it's primarily the services. All right. So what happened to the recession? All right, everybody wants to know. All right, I categorize it in one simple concept: fighting the Fed. We all know the Fed came to the inflation party late in 22, and it rapidly increased rates. We got a chart later on to show you how some of the big rate increases took place over the last 20 months. However, at the same time, the Fed has been trying to trim with the only tool they have. The only tool they've got is raising interest rates and buying cars and houses and investing in plant and equipment more expensive. That's it. That's the only tool they have. All right. Despite that tool, what we've seen a whole bunch of other actors in the economy fighting the Fed. One is Congress and the president. Deficit spending. This year, we're probably $1.6 trillion deficit. Last year, it was $1.5 trillion. This just keeps going on and on and on. By the way, these deficits that we're running are 5.5%, almost 6% of GDP. These are historically, on a percentage level basis, big deficits, particularly when you've got less than a 4% rate of unemployment. So they're fighting the Fed in terms of increasing demand for production of goods and services while the Fed is trying to damp that activity. Consumers, we're just as responsible. I may be personally even more responsible for fighting the Fed. We are coming out of that COVID shutdown for a year and a half, and we are spending money. We're doing what we want. Now, we had a lot of pent-up savings. We got some stimulus checks. We've gone through all of that, but we haven't stopped. We like that lifestyle, and we haven't stopped, and we're continuing to spend, despite in the back, there's a little voice back there saying, you know, you might want to save a little for a rainy day just because. All right. Stock market, well, if you looked at it the last couple of months, yeah, it's fighting the Fed big time. It is optimistic, and we'll see why in a little bit. Labor unions, labor market's very tight. Everybody's got a job who wants a job. There's still millions of job openings. More importantly, we've seen incredible wage increases from labor unions this year. All right. And finally, the whole idea of potential quantitative easing going ahead in 24. So those are all things that are going on. So here, this is not the COVID CARES Act that popped out in April of 2020. All right, this is since then. All right, this is since January 1st of 2021. 2021. $4.8 billion of expenditures over 10 years. All of them are deficit generators, except the Inflation Reduction Act. If you look at the CBO scoring on that, it actually winds up being a net positive over a 10-year period. The problem is there are no pay-fors early, so it's generating deficit now. The pay-fors don't come until year 5, 6, 7, and 8. All right, that's the CBO 10-year estimates of the cost of all of these bills that have been passed that are all generating deficit and therefore demand for goods and services. Here's our deficit. This is the last year that we looked at, 22. All right, and you can see it's just trending down and down and down. This is the CBO budget deficit estimates, the Congressional Budget Office. They're as honest. They're fairly good at this. They're non-political. I know, they're in Washington, but they're non-political, seriously, and they're very good at this stuff. U.S. debt to GDP, right now we're sitting at 123%, which is historically our highest level ever. Even during World War II, it didn't quite reach this high. And by the end of this play on this 10-year forecast, we'll be 133%. Now, don't get nervous. All right? At that point, there's not a whole lot of a problem per se. There's no magic number of, once you hit 112% of GDP, that's it, you're done. No. I mean, Japan has over 200% debt to GDP. So there's no hard and fast rule, all right? But, and here's the big issue. If you keep spending $1 trillion, $1.5 trillion, $2 trillion more than you're taking in, there's no productive service for that demand. So you're not making anything to support that demand. You're borrowing money to support that demand. And you get a mismatch in supply and demand, and that's inflationary. Okay, personal consumption expenditures, this is you and me, this is us. And you can see it just, here we are back at the dip during the COVID shutdown, and here we go. Never stops, okay? You'd think we'd start to taper a little bit, that we've gotten it out of our system, but we like the lifestyle, huh? Raise your hand, how many of you here like the lifestyle? I got one, yeah. All right, good. Consumer debt, we're spending like crazy. Talked to a friend of mine in one of the big banks here. I asked him about, hey, the real estate bubble, right? He said, no, we're not worried about that. We're worried about credit card debt. That's the one that scares them the most in 2024. We already see slow pays up, the rate of slow pays up. And this is because, boom, this is what's going on. All right, and this is the Dow Jones, and this doesn't have Tuesday, Wednesday on this. Okay, so I didn't get yesterday's pop, but we're now up at 37? Yeah, I don't know what's going on. U.S. monthly total employment. We came in with 152. COVID struck. We lost 20 million jobs. I get the numbers all messed up. We got back in June 22 to basically this level, and now we've added another. You look at that, 5 million jobs in the last year and few months. I mean, the economy is hot. Okay, and here are the jobs. We talk about them tapering here, but I look at these and it's a little slower than it was here. Okay, but these are the big numbers right here, and it's been clipping along. And every once in a while, you get a month. But 199,000 jobs. That was last month's, November's private sector job, non-agricultural job number. 199,000. You extrapolate that over 12 months, that's 2.5 million jobs a year. That's a strong economy. Okay. All right, union contracts. This is the last fight of fighting the Fed. We see UPS, American Airlines, Delta. The United Auto Workers is a little misleading. They signed 25% for GM, Ford, and Stellantis. However, that hides the fact that some workers actually got increased 75 to 89% if they were in the first few years of the contract or employment. There used to be a two-tiered system in the UAW where new workers for a number of years were paid really, really low wages, and then they crept up. Everybody's now making the same, essentially, based on the new contracts. All right, so inflation, let's talk about that a little bit. All right, so this is, everybody wants to talk about inflation today, but I think it's hard to get a handle on it if you don't remember the 70s. I'm looking around here. I don't, yeah, maybe one over there. Yeah, okay, yeah. We got a few that remember. The problem is everybody making policy today, guess what? Not so sure about what was going on back in the 70s. And it was a roller coaster, okay? Bump, 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 bump. Here's the CPI, the federal funds rate. And I call this the go and stop Fed policy. Okay, yeah, we're gonna deal with it. That should be enough. And then they start reducing rates and federal funds comes down and then boom, it starts going up again. So it was a roller coaster until they finally, if you could see, really got separation between the federal funds rate and the consumer price index. So it really took almost a sledgehammer approach to take care of that. All right, I gotta move along. Okay, so here's what the Fed's been doing recently. Once they started back in March, a couple of modest increases, and then they had the 475 basis point in a row increases, caught everybody by surprise. They took the pause in June, and the last three meetings they had a pause. And yesterday, Mr. Powell was kind of, we could be relaxing things in 24, and of course the market went bonkers in response to that. All right, but here's what's going on, okay? So here's the federal funds rate, this gray line, and we're at about 5.33 effective federal funds rate right now. And we've seen the core CPI, the blue line, come down significantly. Last month it was 3.1%, November, all right, year over year. And so that's like, oh, that's not bad. However, if you look, much stickier is the core, all right? And the core is everything less energy and food. And what's been driving this rate down, particularly since the summer, all right, has been energy prices. I don't know how you feel about this, but gasoline, anybody here pay over $3 for a gallon of gas lately? Nah, I didn't think so. If you do, I know a couple of stations. No. So gas has come down considerably. This summer it was $4. And that's a big part of driving the overall CPI down. But it doesn't affect the core because the core has everything but energy and food in it. All right, so that's a big issue. And that's stickier, and that's still double where the target is, okay? All right, so today's inflation pressures, all right, we've got domestic deficit spending, I've already talked about that. We've got student loan payment holiday. Now that just ended. We're not sure exactly whether, we haven't seen the data yet whether students are actually starting to repay, former students who have loans are starting to repay their loans, but they were given a holiday for over 3 years from having to pay or for interest to have accrued, all right, because of the COVID shutdown. So this fall they started, okay, it's time to start paying again, and we haven't seen what effect that has and how many of them are just saying, I'm out of here, okay? We have child care credit, which is again sending checks to families with kids. And then under the radar, because it was not a congressional thing, the SNAP benefit upgrade, which is a couple $100 million, a couple $100 billion, which all they did basically was the food and drug, change the calorie content and mixture, and that increased the benefit to obtain that calorie count and a mixture of carbs, protein, and fats. Yeah, scientific stuff. Don't worry about it. All right, but that was a couple $100 billion of additional costs, unfunded, and not passed by Congress. All right, on the cost push side, and we'll talk about this a little bit later on, we've got a wage catch-up. We know about the declining labor force participation rate as the population ages and people do what they do when they get older, and that's stop working. All right, and with labor force participation rate is number of people, so it's this fraction. Number of people working with a job, number of people not working but looking for a job, and that's divided over the population 16 years of age or older. But there's no cutoff. 65, 66, 67. You can leave the denominator, but you'll never leave the, excuse me, you leave the numerator, but you'll never leave the denominator. All right? Extended supply chains that are starting to collapse, but we still have them. One of the things that's interesting is, yeah, we're de-emphasizing supply chains in China, but they're not necessarily all onshoring. The vast bulk of them are going to places like Thailand, Vietnam, India, et cetera. All right, so we haven't seen Apple come back and start making iPhones here. They're moving some of their production to Vietnam, some of it to India, et cetera. Expanded regulations as a part of the Biden administration, and energy prices are always the wild card. You know, I go back to this number here. There's stuff happening in the Middle East where a lot of energy originates. Okay, you have no control. We have no control over energy prices. Even though we produce enough oil and gas for our own domestic needs, we're not a net importer of that stuff anymore, but the price is set worldwide, okay? So it doesn't matter. So unless we stop exports, which we can't do for a variety of reasons, I'll talk about that later, unless we were to stop those, we can't affect the price of it. The world determines the price. All right, so inflationary expectations. And that's simply the rate at which people, consumers, businesses, investors, expect prices to rise in the future. And once you go through a process where you've had prices rise by almost 20% in a 2.5-year period, you start to believe that inflation is part of the process. It's what you expect. You walk in the store a couple of weeks ago, you know, a jar of peanut butter was, please don't get me wrong, like $4 maybe? I don't know. What's peanut butter cost? $4, and you walk in the next time you buy it in 2 months and it's $4.25. You don't say, "Oh no, I'm not doing it." You expect it to happen. All right. So household saving levels. I told you we pretty much got rid of them and obliterated them, and so as a result of that, we've had this decline to where now the household saving levels, $815 billion, are much lower than when we went into this whole thing. This is the roller coaster. This is the savings because we couldn't spend money. These are some of the checks that have come as part of some of these programs to send checks to people to stimulate their spending and hence creation of jobs to get everybody back to work. Number of job openings, we've seen this come down, but there's still over 8 million job openings. Still over 8 million job openings. We don't have the labor force to fill that, all right? Federal deficit, you've seen this slide before, ongoing and affecting potentially affecting inflation. And then finally, the Fed balance sheet, it peaked up here at 8.9 trillion in the heart of the COVID recovery. And now it's back down to a little bit less than 8. This is what they call Fed tapering. But you'll see in just a minute, there's not a lot more they can do in this. All right, so I got just a few minutes here for economic headwinds, so let's see what's going on. So here's what we've got that we're looking at that could possibly be a problem in 2024. We got consumer confidence, energy prices, Fed interest rate policy, inflation could come back again, wage catch-up, and so on. So here we go, the consumer sentiment from Michigan, and you can see that it took a hit, you know, in 2020, but it's still been going down. Now, it's recovered a little bit, but this is not a very healthy number. If you look at 61.3, which is the most recent number, it's not a whole lot different than October of 08. Now, you remember October of 08? Does everybody here remember what happened? You know, you got up in the morning, watch people walking out of Lehman with boxes. Uh-oh, banks are failing. So despite the fact that the economy is not in recession, that the unemployment rate is less than 4%, and we're growing pretty consistently at over 2%, people aren't comfortable. They think something else is going to fall. And that's never a good thing because 70% of our economy is driven by consumers. Consumers aren't happy, the economy's not happy. So this is a number that really bothers me considerably. I've talked about energy prices. They're not as low as they have been recently, but they're a whole lot lower than what they were in the summer of 21 when we had $5 a gallon gasoline. All right, so you've seen this slide before, we've talked about it, but it's just sticky core CPI. This is what I'm concerned about. This thing is starting to level off. I'm not sure that much is going to change because it's predominantly service driven, and I think that that's pretty sticky right now in terms of prices coming down in those sectors. Here's that gap. This is why people aren't happy. Inflation's gone up by 16.9% since January of 21. Prices have gone up by 16.9%. But unfortunately, wages have only gone up by 14%. So this is what I call the wage catch-up. Everybody has less, on average, people have less purchasing power today than they had 2.5 years ago. They're going to want to catch up, okay? And that becomes inflationary. That puts inflationary pressure on. Seen this one before, but this does concern me. By the way, this is, of course, a forecast going out to 2.8 trillion, and by 2032, I believe. But I'm pretty confident that that's going to happen because I'm sure as heck haven't seen a whole lot of determination in Congress to change the trajectory here. All right, so Fed resolve. So let's interpret what Jerome said yesterday, or Mr. Powell, I should be. All right. There's an 800-pound gorilla in the room that no one talks about. I watched the press conference yesterday, not one question on what I'm about to talk about. For years, the Fed has been a steady moneymaker. It started in 1913, so it's 100 plus years. We're close to zero federal funds rate, and the income it earned from a massive balance sheet, the Fed has been able to hand back nearly $1 trillion to the government. Fed is not a line item in the Federal Reserve, in the federal budget, the Treasury budget. It's a profit-making. It's an independent company, essentially owned by the banks in the district that it operates in. So it's a money-making deal, and it returns money to the Treasury when it makes a profit. In 21, $109 billion back to the Treasury. 22, 76. However, that changed in the fall of 22 when the federal funds rate moved high enough that the income derived from those bonds that they bought to finance all of that deficit spending in the COVID recovery, all right? That 4.8 trillion I was talking about, plus the 2.2 trillion CARES Act before that. Those bonds are all paying 1 or 2%. And now they're having to pay between the federal funds rate is now between 5.25 and 5.5. They have to pay banks the reserves that banks have on deposit at the Fed, and there's like 3.7 trillion of that right now. So Bank of America, Wells, every bank has deposits at the Fed. They're called reserves, and they have to pay a 25 basis point premium over the federal funds rate. So they're paying out over 5.5% on $3.7 trillion. They got about 5 trillion in bonds paying 1 to 2%. You can do the math real quick. The spread's the wrong way. They're losing money. And so far, they're at 120 billion that they owe the Treasury. They're upside down, in the red, $120 billion. Okay, what's the problem with that? It's just I get some accountants out here and they'll explain it all to you. Just put a couple of numbers over here and a couple of, we're good. All right, uncertainty, okay, so here's what's going on. The Fed is going to start looking at what? Have we solved the inflation problem? You saw what happened in the 70s. Have we solved the inflation problem? The problem is they've got a conflict. The longer they stick to high interest rates, the longer they wait to lower the federal funds rate, guess what? The longer in debt they become, all right? The more debt they accrue. So they have a hidden incentive that nobody talks about to reduce interest rates sooner rather than later. However, we've got 4 meetings coming up in the first of the year, all right? Which one of these is going to signal the rate cut? I don't know. People are talking about, a lot of people like this May 1 meeting is to when they're going to start cutting rates. The problem is, if they lower rates, they increase the likelihood of a soft landing. That's something that Jerome Powell wants in his cap, feather in his cap, soft landing. I got inflation down without a recession. I'm the new maestro. That's what they used to call Alan Greenspan. All right, I'm the new maestro. However, and it reduces Fed losses. They stop losing money. All right. However, it increases the inflation risk going forward. All right. And it's likely that if inflation comes back in the second half of 24, what's going to take place is they're going to not get away with raising them again to 5.25. They're going to have to go to 6, 6.5, and they lose more money. So there's a downside risk of that strategy. On the other hand, if they keep rates at the covered level longer, they do have a better chance of controlling the inflation, but they also increase the chances of a possible recession in 24, and they increase this total sum of Fed losses. What's that trigger number before Rand Paul holds a hearing? I just ask you that simple question. Because he doesn't like the Fed, and he doesn't like the Fed independence. So these are all questions no one talks about, but I think are real significant in terms of what the Fed's going to do in 2024. All right. With that all being said, what's going on in our economy? It's going to be a boring year. All right. 1.9% growth. It's going to trickle along. I don't think much is going to happen in 24. All right. And if we look at it on and again, the scale's different on this because the top growth here is 4.8% in information, but overall it's only 1.9%. Same sectors are generating growth. Most sectors are going to do fine. It's going to be a fairly vanilla year. There aren't going to be winners and losers to speak of. It's going to be a fairly we're going to bounce along. Nothing great's going to happen. However, you can notice that the job growth is going to be about cut in half. Okay. Companies are going to be a little bit more cautious about hiring. We've already started to see that. Job openings that they may have had 6 months ago, 4 months ago, they didn't fill. They're not offering those jobs anymore. They're cutting back there. I don't think they're going to start laying off in 24, but I don't think there's going to be a lot of job growth taking place. So you're not going to see the job switching and those types of behavior taking place. By the end of right now we're sitting at 3.4% rate of unemployment. We're a little bit better than the Fed number, federal number at 3.7. I think it's going to creep up here by the next year at this time to about 4%, maybe 3.9, 4%. We'll see what that happens. But if we only create 53,000 jobs, we're a net immigrant state. We're going to be growing in population, so it's going to put pressure on the unemployment rate. But hey, 4% is still pretty darn good. All right, so key takeaways look forward to. The exogenous shocks matter, not just oil prices, but all the wars that are taking place, the effect that might have on oil availability and transport, et cetera. Fed policy matters, how resolved they are to continue to solve the inflation problem. I think there's a 50-50 chance of a return of inflation in 24 if the Fed eases too early and too strongly. The wealth effect, as the stock market goes up, guess what? You feel wealthier, and guess what you do as a consumer? I don't need to save, man. Let me sell a couple of those shares and we'll go to Florida this winter, okay? That's what happens. No, I'm serious. That's what happens. That's how people think. I think there's less than a 30% chance of a recession in 24. I really don't see a recession on the horizon. And I think that's 30%. I mean, honestly, I said 30, 70, 20, 80. I don't think there's much of a chance. I wouldn't worry about it. All right, so keys to watch. Fed tapering, quantitative tightening, reducing the balance sheet, reducing interest rates. Government shutdown, that's one of those wild card exogenous shock things. And this time it's a two-tier thing. You might slip by in January because the easy budgeting things take place in January. The harder budgeting sectors have to take place by February. Or we might have another CR. I don't predict what goes on in Washington. Energy prices always a wild card. We've seen that energy price decline has brought down overall inflation, the overall CPI. It can bring it back up just as fast, and we don't know what's going to happen. Consumer confidence, the next one comes out in January. U.S. monthly job growth and unemployment number comes out the first Friday. Our December CPI comes out in January 11th. You can get all these alerts on your phone if you sign up for them. They just phone buzz. Oh, yeah. The FOMC meeting in January, probably zero again. I don't think they're going to do anything. And the fourth quarter GDP, which is going to be something that's going to come in and not be a good number, probably 1.5%. It's not going to be negative, but it's not going to be a strong number. Will pop up on January 26th. It'll be a first reading of GDP. Overall, I think we've dodged a bullet. We didn't have a recession in 23. We're not probably going to have a recession in 24. The real question is, how long is it going to take? Does the Fed have the incentives in place to keep interest rates high enough to ensure completely that inflation gets back down to that 2% level? And that's the unknown, and that could cause problems in the second half of 24. That's the wild card out there that still has that little 30% chance of a recession. All right, that pretty much takes care of it. Thank you very much for your time, and we'll be opening up to questions from the audience and from those that are watching on Zoom. Oh, we got a question already. Yeah. Speak loudly.
So Dr. Connaughton, with regards to like O'Connell's law and things, do you see unemployment increasing as they keep the federal funds rate higher?
Okay, the question's about Okun's law and whether or not if the Fed continues to keep the interest rates high throughout 24, will that lead to an increase in the unemployment level potentially above 4%? That's an excellent question. The answer, I think, is if they were to do that, I think the answer is yes, it would. The question is, and my belief is that they're not going to. I think they're going to fall victim to the pressures, both from their dual mandate of full employment, okay, in addition to stable prices, that's a congressional dual mandate, and the fact that they're losing money, I think is going to lead them to lowering rates. That's why I'm more concerned with kind of a rebound of inflation in the second half of the year rather than an unemployment rate that creeps above 4%. Okay, well, yeah. Artie, you help me out here.
Yeah, we'll alternate between in-person and virtual unless I run out of virtual. So banks are offering the highest yield rates we've seen in the last 10 years. Is this something that will continue and will prime be a contributing factor to this?
Okay, so everyone got that question. So what's going on right now, if you watched yesterday and today, if you watched Treasury rates yields, they've come down considerably in response to the likelihood that we're at the peak, all right? And so a lot of people are wanting to buy these bonds, okay? Demand goes up for bonds, price goes up, demand of anything goes up, price goes up, right? Interest rates come down. So yields are coming down on bonds, and they'll start coming down on those savings, 90-day CDs you have. So if I read the Fed's language yesterday correctly, and you want to, you're comfortable with getting 4.5%, 5% on cash money and not getting in the market, it's time to lock it in a little longer. I wouldn't go real long, but I would think that locking that number in, because on a 90-day basis or even on a money market basis, you're not going to be getting those rates in 2 or 3 months. Yeah.
Are there any other levers the Fed could pull to deal with that loss besides lowering interest rates?
Are there any other levers that the Fed could, I guess everybody got the answer. The answer is no. I mean, it's just a real simple spread problem. You're paying a whole lot more for money than you're getting on your investments. And you're just upside down. The only other money-making thing that the Fed does is services for the commercial banks that are members, clearing checks, that wired money, that kind of thing. And that's not a big income stream. Historically, they're like regular banks. They have a spread on what they pay for money and what they loan it out for. And that's upside down now, and it's big numbers. It's, as I said, I looked this morning, I think it's 3.7 trillion of reserves that they're paying, basically 3 percentage points higher for those reserves than they're taking in or receiving from the bonds they own. They own about 5 trillion in bonds. But even though they own more bonds, it doesn't make up that big gap.
So I'll take one online. Do we anticipate our housing market to remain as it is or further slow down?
Oh, great question. Housing market. I suspect that if the Fed does what we expect the Fed, certainly what the market is considering the Fed's going to do next year, the 30-year Treasury is a pretty good indicator of where mortgage rates should be. So if everybody believes the Fed's going to start easing and start lowering rates, and as I said, we've seen bond rate yields come down considerably in the last 24 hours. And it's been a big drop. I mean, we're talking 50, 60 basis points in some instances. And as a result of that, I suspect we're going to start to see mortgage rates start to begin to fall pretty quickly as well. That coupled with you guys being out of control, consumers, demand for housing is going to be there. Mortgage rates are coming down. We're going to start to see builders start increase. And that in and of itself, I think, should be a stimulus to the economy, but I don't think it's going to be enough to push it much past 2%. Okay. I'm sorry.
I have two questions, if that's okay. One is, are the baby boomers leaving the job market at a rate? Are they starting to kind of leave the job market that can help out with the labor?
Who?
The baby boomers. I know that
we're history.
So it's not.
We're out of here.
So that's not really affecting.
Okay, I don't have
the job market.
Okay, I don't have the chart here on the slide deck. I've talked about it in previous presentations. But if you look, there is a data collected on the demographics of the United States, and you look. They do it by 5-year age cohorts. All right, and if you look at the last of the baby boomer ages, which are now they're starting to hit 60. Okay, because remember the last baby boomer was born in 64, so we're real close to getting 60 years old. So when you look at that age cohort, the 60s to 65s, and you say, all right, there's 22 million of them, and they're now in the process of leaving the labor force, right? They're starting to retire, all right? Who's coming in? The 16 to 19-year-olds. They're going to start to move into the labor market, right? And that's about 1 million people fewer in that 5-year age cohort than are getting ready to leave.
Yeah.
So we're not as, look, we've seen this before in a lot of other countries. Japan, Germany, they all have declining labor forces, okay, because of the aging. So many people were born post-World War II in those countries, just like this country. So this is a phenomenon that goes back to what was taking place after 5 years of World War, and then it's like everything else. It's over, and you all go celebrate, and you go a little bit out of control for 10, 15 years. Look, no, I'm serious. People matter, and people's behavior matters. And as a result of that, we had big population explosions in Europe, in the United States, in Japan. That's all gone now. And so, unless you can convince baby boomers to work into their 70s, this is not going to change. This is a trend that we're on. Okay. Yeah, Artie?
So in terms of your prediction of a 4% unemployment rate by year's end 2024, do you envision certain North Carolina sectors being more impacted than others, and whether that's more affected at the big companies or small companies?
Okay, so so anyway, one, I think that growth is going to slow, but as I said earlier, population in the state's going to increase. We are attracting young people. So it's a zero-sum game or negative game for the U.S. as a whole in terms of labor force sizes that you were talking about, but we are a net benefactor of in-migration. So our labor force is going to grow, but I don't think the economy is going to be strong enough to employ all of those that come in, all right? So that's why I think that the unemployment rate is going to rise ever so slightly, okay, over the next 12, 13 months. As far as what industries are affected, I think 24 is going to be an incredibly benign year. I don't think there's going to be any explosions in industries doing particularly well. We don't have the magnificent 7 industries in this state. All right, so we're sitting here with pretty standard, we're almost a microcosm or a snapshot of what the U.S. economy looks like in terms of finance, insurance, and real estate, construction, trade, manufacturing, et cetera. So I don't really see a whole lot of sector pain or growth that's different from overall in 24.
Hello, Doctor. I had 2 questions for you. I hope you don't mind. The first is, could you talk about the corporate debt rate? And then second, if you could talk, I don't know if you have any knowledge on this, if you could talk about some of the agriculture in the state. I saw for both years that agriculture is down big.
Yeah, let me deal with the second question first, because it was kind of surprising to me. If we were to do this 2 years ago, agriculture would be like 1.2% of the economy. Now it's less than half of that. It's like 0.6%. I have no idea what happened. I just get the numbers. And I don't mean to be, cavalier about it, but I don't follow internally that sector that much because it's only a 1%, 1.5% sector historically. But there's been a big decline in agricultural output in this state over the last 2 years, which I don't have an explanation for. So, okay. Corporate debt, I think that's I don't think that's an issue. I'm more concerned about consumer debt. One of the things that everybody gets, I don't know, they get mixed up or they just don't dig into the thing. When you look at GDP, and Artie, you'll like this, C plus I plus G, all right? When you look at the GDP, consumption is the big driver. Businesses, the investment side of things, is relatively small, both in terms of its effect on aggregate demand, but also an effect on generating part of income, okay? So as a result of that, I don't really see corporate debt as a significantly big issue. I mean, I think there are some issues out there on the business side of things. One, of course, we all know this is commercial real estate. We don't know where this balance between work at work and work at home is going to fall. But we do know that office vacancies are up across the country in most large cities. Certainly in Charlotte has one of the highest vacancy rates of any big city in the country, office vacancy rates. And so we don't know where that's going to go. We really don't know where that's going to go. So I'd be more concerned about commercial real estate than I would be about corporate debt. And as I told you earlier, the banks are more worried about consumer debt and credit card debt than they are about corporate real estate.
So I'll ask one from here. I know you don't predict what the people in Washington are going to do. That's not what you're here for. But the election cycle next year that we're going through, any thoughts on how that will impact the economy?
Okay. So newsflash, in 24 there's going to be a presidential election. Okay. And every presidential election year, believe it or not, tends to be fairly benign in terms of the economy. Nobody does anything really big. So if, for example, the Democrats had some big idea that they think if we could get this just through Congress, this would really help Joe Biden get reelected because people would love it. It's not going to happen. On the other hand, if Republicans say, well, if we can get this thing passed, it'll be a black eye for Joe Biden, it's not going to happen. So what happens is, okay, they get entrenched in their own side of the aisle, and there's less cooperation across the aisle to get things done. Because you look at some of those acts that we talked about earlier, like the CHIPS Act and the infrastructure, et cetera, the Inflation Reduction Act, they had Republican votes, okay? They didn't hinge on a very slim majority. They were passed, and passed easily. That's not going to happen in election year, and that historically doesn't happen in election year because everybody's posturing. So that's why 1.5%, 2%. Yes, sir.
So so I guess our current debt is $32 trillion.
32, 33,
So
34.
and I guess in
Don't Google www.debt clock. It'll mess your whole day up when you watch that thing just. It's about another 10 million more since you started the question. But go ahead.
Okay.
I'm sorry.
All right, we're very good. So I guess in January of 2027, tax rates are scheduled to revert back to what they were in 2017. So do you think, and currently I think our interest rates are about as low historically as we've seen in a long time. So in your crystal ball, do you see rates returning back to what they were in 2017, or do you think that I can't imagine them going any lower? But what is your thought? What's going to happen?
Honestly, sir, I have no. I mean, that's a great question, and I don't have an answer for it. My crystal ball subscription doesn't go that far ahead, so I really don't know what's going to happen. I do know this: that if tax rates were to go back to their pre-2018 levels, that would be recessionary. That's a guarantee. For how long that recession would last, I don't know. Now, the more interesting part of your question is, well, where's kind of the long-term stable interest rate environment going to be? So we know, at least I think I know, that post-Great Recession up until, what, 2017 or so, those zero rates were unusual, to put it mildly. I mean, the Fed was, all right, you all got about 4 minutes, so I can go a little off. So what happened in 2009 was the Fed developing a new tool to affect monetary policy corrections to the economy. They called it quantitative easing. You remember that, right? QE1, QE2. I thought I was on a cruise liner, but QE1, QE2, QE3. And what happened was the Fed was accommodating debt. Now, initially, it was treasuries. But they, during that period of time, they also bought MSBs, MBSs, mortgage-backed securities, and they also bought car loans, believe it or not, to try to stimulate those industries. And they ramped, during that Great Recession period, they quickly ramped up the Fed balance sheet, you're gonna love this, from $800 billion to $4.5 trillion. And that was quantitative easing, and that became a new tool. Secondly, we had a lot of banks fail or get close to failing as a result of contagion from the Lehman failure. To the extent that there were some shotgun marriages, we're familiar with the one in this town between Wells and Wachovia. However, what they determined was that the old rules to try to maintain safety in banks were not enough, and so they were going to embark on a new rule or new program called interest on excess reserves. So they're going to start paying interest, or IOER as they called it, on, bless you, on excess reserves to get banks to keep more reserves on deposit at the Fed. We will give you 25 basis points higher than the federal funds rate. It's a good deal, right? And so, bless you again. And so what we saw was an increase in the amount of reserves at banks, at the Federal Reserve Bank. All right, and that they now call adequate reserves. What you don't know that happened is in the summer of 2020, that required reserve ratio went away. And we also know, so there's no longer a required reserve ratio on checking account demand deposits. And they never reinstated it. In August of 2016, when Janet Yellen, then Fed chair, spoke at the Jackson Hole Conference, she institutionalized interest on excess reserves, which is now interest on reserves, IOR, as a monetary policy, safety, and management tool. And so they're playing with a whole new set of rules. And here's the answer to your question you're asking. So in the days past, or lectures past when I would do this, I always had this picture of Yogi Berra. You all know who Yogi was, right? Mm-hmm. Okay, the orator of yogiisms. Okay, maybe the philosophical genius of the 20th century. But anyway, he had this quote. He once said, you got to be real careful if you don't know where you're going because you might not get there. And that's really the kind of way I look at what the Fed is doing now in terms of their tools. Their balance sheet is, what, $7.8 trillion now? We've seen the problem at excess reserves that I don't think anybody thought of in 2012, 13, 14, and 15 when they determined to institutionalize that as a monetary control tool. So at the end of the day, you're asking me, where the heck are interest rates? I don't know, and honestly, I don't think they know where the natural interest rate should be in a stable economy, neither expanding nor contracting, what we call in the business either a recessionary or inflationary gap. When we get rid of those gaps, what should be the interest rate? And that is a concern, and it's a worry, okay? Sorry, you touched a, yeah, it hurts.
Right. So we've received some great questions. We'll have time for just one more. If there's one more from the audience.
Yes.
What, if anything, stands out to you as maybe something to look for as you compare the local Charlotte economy to the North Carolina economy as a whole?
Okay, yeah, good question about North Carolina, the local economy, the Charlotte economy. This place is crazy right now. And it is, I have this very simple economic outlook meter, if you will. So when I drive around and I look around, what I'm looking for are cranes. It's been 20 years since I've seen as many cranes in Charlotte as I see this year. Okay? What that means is there are a lot of people working, because those cranes, last time I checked, they're not robotic. People actually work them, and when they move stuff around, people pick that stuff up and they do stuff with it. My point being is that construction industry here is a whole lot different than it is almost anywhere else in the state. And it is really booming. The last time I saw this many cranes was about 4 years ago when I got a ground stop at Washington National Hotel, and I'm sitting in the airplane looking around and all the cranes that are down there in Alexandria, Virginia area. So yeah, it's a funny answer, but I think it's an appropriate answer in terms of things in Charlotte are doing really, really, really well. Okay? All right. I think that's 12:59.
So
oh, you got one more?
Nope, I'll wrap it up. I'm going to ask you my question later, which is if I fight the Fed, does the Fed win?
Yeah. Thank you, Bobby Fuller.
All right. So thank you, John, for your insights today.
Much, and thanks to you all for coming.
Thank you all for joining us for the North Carolina Economic Forecast. Sponsorships are available year-round for the North Carolina Economic Forecast. Please contact us if you're interested in supporting the research that underlies the presentation and connecting with the business community, our alumni and students. To help us plan for future events and to be entered for a chance to win a Belk College gift pack, please complete our brief online survey by scanning our QR code. And that will conclude our program for the day. Thank you all.